Number 19 is the law of the stock market. This law says that the value of a stock is the total anticipated cash flow from that stock discounted to the present day. What this means is that a share of stock represents a share of the ownership of the company. This share entitles the owner of the share to all the benefits and risks of ownership, including profits, losses, as stock increases, declines in value, good or poor management, and increasing or decreasing demands for the products or services produced and sold by the company. When you buy a stock, you are investing a certain sum of money and betting that your return will be in excess of what you could earn in a guaranteed investment, such as a bond or a money market fund. Purchasing a stock is a form of gambling because the future of the company and the value of the stock are both unpredictable. They are determined by countless market forces such as sales, competition, technological change, interest rates, quality of management, world events, weather, and many other things. The first corollary of the law of the stock market is bulls make money and bears make money, but pigs get slaughtered. This means that people who invest aggressively when the market is rising make money. People who sell short and protect themselves when the market is declining make money. But greedy people who try to make a killing in the market almost always lose money. More than 70% of day traders, people who move in and out of the market completely one day at a time, lose money, and many of them lose everything. The second corollary of the law of the stock market is that long-term investing in the American stock market is the best way to achieve long-term financial security. The value of stocks traded on the U.S. markets has increased an average of 11% over the past 80 years. As a result, a person who began investing at the age of 20 and who invested $100 per month in a mutual fund that increased an average of 10% per year would retire with a net worth of more than $1 million. The third corollary of this law is that dollar cost averaging in the long run will make you rich. What this corollary means is really that there is no such thing as market timing. It is virtually impossible for you or anyone to consistently buy stocks when the prices are low and sell them when the prices are high. It's always better to buy the stocks of good, solid companies selling valued and respected products and services, and then hold those stocks for the long run. Corollary number 4 says, the stock market is managed and made by professionals. This means that every purchase of a stock represents the sale of that same stock by someone else. The person purchasing the stock is betting that the stock will increase in price. The person selling the stock is betting that the stock will decline in price. Every stock purchase and sale is therefore a zero-sum game at that moment, with one person betting his wisdom and judgment against that of another person. Most of these people are professionals who do this for 50 to 60 hours every week. This means that your safest course of action is to invest in an index fund that represents all of the stocks in that index and which goes up or down based on the average trend of the entire market. The most popular index fund is based on the Standard & Poor's 500. This index fund has consistently outperformed more than 80% of professionally managed mutual funds over the years.